Hey everyone, this is a full detailed case study of a full risk analysis and insurance recommendations from the case study that we did on the show a few weeks ago, and some of the advisors did all the wealth planning and mortgage stuff, where this case study is actually just detailed on the life insurance, the total and permanent disability insurance, the trauma insurance, and the income protection insurance. So take a watch of this if you are considering getting your suite of insurances reviewed or taking out insurance. I just think it's such a big need if you have debt or dependents. But if you are still living at home and you're working full time without the mortgage and without the family, I believe there is a need for income protection insurance and disability insurance. So have a watch of this, see the flavour that Sky Wealth has when dealing with case studies, and there'll be a link below if you want to connect with Sky Wealth and make it a priority to get your life insurances sorted this year. It's very important to note that you don't have to just go to your super fund. I would recommend go to a financial advisor, as they can set up more comprehensive policies and also policies that are more portable, so you're not stuck with your super fund. You can have policies funded from your super fund and set up externally to the super fund. So take the time, watch and see how this analysis folds out and what recommendations are made. I'll hand it over to Phil Thompson from Sky Wealth to go through the case study right now.
Hello there, I'm Phil Thompson from Sky Wealth. So I'm recording a longer deep dive video about the case study that I did with Glenn James at the live show. So I'm going to be talking about the insurance needs for Sam and Olivia. So some of the considerations that we're going to talk about is what is their existing cover? What are the considerations there? Going to be talking about things like the levels of cover, so the sums insured that we would be considering for these guys, and how do we think about those numbers? And going to be talking about costs. So we've done some quotes for these guys and then comparing their existing cover. So would we be going with their existing ART cover and increasing that if we think they need more cover? Or for Olivia, will we be increasing Aware Super? If not, why not? And we'll talk about that in a lot of details. So to get started, some of the considerations that we're thinking about is Sam has some cover with ART. Sam is 36. Good news is the default cover just increased last year when he turned 35. So it went from $125,000 for life and disability to $240,000. Now for a young family with a bit of debt, mortgage, a bit of car loan debt, low savings as well, low levels of cash, it is important that they do have cover. Now, some things to consider is like Olivia is going to be potentially getting $200,000 from the NAN as well within the next 12 to 18 months. Now they do want to look at paying off the home loan faster, some things like that. So that may come into a consideration. But when it comes to inheritance, it is always good to forward plan for them, but you can never guarantee that they're going to hit the bank accounts. You can always take out a level of cover today based on the need today and then reduce over time. It's really easy to reduce your level of cover, but to increase it, if we planned ahead and said, let's reduce the level of cover based on that 200K. If we needed to increase it in the future, that does actually become a little bit harder as well. So the other thing to note, just touching on their existing cover. So Sam has cover with ART. Now, with the disability cover for ART, with the default cover, one thing is it's disability assist. So it only pays out a percentage. So 25% of the total payment will be paid out at year one, and then 15% every year for the next few years. So it's not a lump sum payment like most disability insurance covers. And so that is something to consider. So if Sam was to become totally and permanently disabled, never to return to work again, there is no income protection. He would only get $60,000 on that initial assessment, and then every single year after that, he'd get $36,000. Now, that's just the nature of that ART policy. While Aware Super is built a little bit different. So that's $500,000 that Olivia has currently, and that is paid out as a lump sum if you're assessed under any occupation TPD. So it means both Olivia and Sam, to get those payments, you've got to be totally and permanently disabled and not be able to return to any occupation the insurance company can reasonably expect you to go back to based on your experience, based on your training. And so it is a little bit harder to take out the cover. So they're kind of the initial thoughts, initial considerations. And to be honest, most of the people we work here at Sky with regards to our clients, they are in the exact same situation as these guys. It's a pretty common situation, got default cover in place, only just covering life and disability. And so that's a common situation that we're seeing. And it's got a high salary, $170,000. Olivia's working part-time 3 days a week, 46 grand, not including super, $54,000 including super. And so some things that to consider is like life, PPD, Royal Mail insurance, and income protection for both, Sam and Olivia. So even though Olivia is working part-time, income is lower. The reason why we think that life and disability is so important, and all the covers are incredibly important, is because there is unpaid work that if Olivia was no longer around, Sam needs to cut back on work, and that has a substantial impact on the household income. So it's not just that loss of income for Olivia if she was to pass away. It is what does Sam's income look like after that. So next, let's talk about the levels of cover. I'll go through in a bit of detail how we get to these numbers. Now, one thing, this case study doesn't talk about health impact. So if we were expecting an exclusion for Olivia or Sam, the levels of cover may be different. So we may be retaining this cover through their group provider and then topping it up elsewhere. We may be replacing. So if we were expecting exclusion, these numbers may change. But just to get into a little bit of detail. So for Sam, we'd be recommending income protection. We'd probably look at a 30-day waiting period given their low levels of savings. But we would be encouraging those guys to, if we can have some emergency fund buffer, a little bit more, maybe a 60 or a 90-day waiting period, we'll have a reduction in the premiums. But we're looking at just shy of $10,000 per month for income protection for Sam. Now, one thing to think about, the reason why we get to $10,000 per month is that is 70% of $170,000. Now, one thing to think about, $10,000 per month is pre-tax payment. So if you're on $170,000 and at the moment, 10 grand a month is not what's hitting your bank account because you're getting paid your after-tax income. So that's exactly what happens with income protection as well. So this $10,000 is pre-tax income. So there will be tax on that. So just round numbers, Sam's probably getting $6,500, $7,000 per month paid in the bank account if on income protection claim. And for Olivia, it's $2,700 per month for income protection payments. Again, Olivia is on a lower income, working 3 days a week, but we feel income protection is incredibly important to have, especially for a long-term claim. Your income is the most important asset anyone will have. And so it is really important that we are covering that, even if it isn't as bigger portion of the household income. It is really important that we're covering both individuals. Now, if Olivia was working less than 15 hours a week, it would be more difficult to get income protection. There are some rules around the insurers not offering cover if she was working 1 day a week. Given that it's 3 days a week, we can get income protection as well. Now, the next policy is disability cover. The reason why we're talking about this next is income protection is very important. And disability cover really wraps around the income protection. So it is a lump sum payment if you can never return to work again. At Sky, the way we think about it is we want to cover your income until age 65. And so that is a mixture of income protection. Income protection carries the biggest burden of that, but we also want disability cover because income protection won't fully cover your income. So some of the things to consider is clearing debt. Now, their home loan is $610,000, so we do want to cover that when it comes to disability insurance. Now, why don't we half that for each Sam or Olivia? Because a household still needs to bear that responsibility. And the way I think about it is if I was to become disabled, I'd want to fully cover my mortgage. And same with my wife, Kate. If she was to be totally disabled, we want to clear that mortgage just to remove that stress and burden. The other thing we think about is medical costs. So we pick out $100,000 for medical costs. Now that could be well under insured. If you're a quadriplegic, the lifetime cost of something like that is in the millions. $100,000 for medical costs won't even scratch the surface. But if you can't ever work again for a mental health condition, maybe the long-term cost overall may amount to $100,000, but it may not as well. So, we could be over-insuring for that. Now, we don't know what a disability claim will be for, and so we estimate $100,000 for that. and then the lump sum to cover the difference between income protection and the income. Now, if you're watching this and this is exactly your situation, you're on this income, this is your household, don't just pick these numbers and go and implement it with an insurance company, because what options you have when it comes to underwriting. So if you're going to get an exclusion or a loading, there may be something different there in terms of what you can get cover for. We may be, maintaining that cover with the group provider. We may be replacing it. So all of these things is just for reference. Don't go ahead and just implement whatever we tell you to when it comes to this video. But these numbers, the reason why Sam has just over $1 million worth of that replacement income and Olivia is $600,000, even though there is such a big disparity in income, but this level of cover isn't that big. For Olivia, we want to cover a minimum of $60,000 a year, every single year until age 65. So for Olivia, just over $600,000 to cover that gap between income protection and what we think is a reasonable amount of money until age 65. And for Sam, it's just over $1 million, that gap between income protection and the pre-disability income until age 65. So that's how we get to these numbers of just shy of 1.7 million and just over 1.4 million for Olivia. Again, if we were speaking to Sam and Olivia, we'd be talking about those levels of cover because cost is a major impact when it comes to insurance, whether they want to pare those down, whether they want to increase it. For me personally, I have levels of cover well over and above what I would be telling myself as a client, because I want to pay a little bit more to have that financial security should something go wrong with me or my wife. But that's not everyone. Some people may want to have less than what we recommend. So next, we're going to touch on trauma insurance. So trauma insurance, the way we think about it is $100,000 of medical costs. Again, that could be under-insuring, it could be over-insuring. We don't know what the claim's going to be. But on top of that, we want to replace income. So for the individual who is sick, we want to replace the gap between income protection and your income for 12 months. So that's why for Sam, that portion of the trauma insurance is higher than for Olivia's. And then when we have couples, the way we think about it is we want to cover after-tax income of the non-ill partner. And the reason being is because we want to empower our clients. Should one of them be sick, there is money in the bank and they can take time off work should they need to. So for Olivia, the level of trauma cover is actually higher than it is for Sam because we want to cover Sam's after-tax income for 12 months. So if Olivia was to have an illness or a sickness such as like cancer, which is, over 50% of claims for females is cancer. If Olivia was to have cancer and go through treatment, they've got money as a household to be able to take time off work. Yeah, there are extra costs when it comes to childcare or looking after the kids. Are there any additional medical costs over and above that $100,000? Just gives them the time, space and freedom, financial freedom to just put down the tools and focus on their family, their relationship, their health, and that financial burden isn't top of mind like it is for most people going through these serious critical illnesses. And for Sam, again, the same, but on reverse, because Olivia's income isn't as high, it's a little bit lower for Sam. We also look at things like child cover. And so we do a default $100,000 per child. And so that if something happens to the kids and they were significantly ill or, were to pass away, there's money there for the grieving family or to, again, help with care. Having a child in hospital is significant and the household cost is really impactful. Time off work and there's not really the option when an ill child is in hospital. And so there's money available there and that's what we recommend for our clients. And then the last thing is life insurance. Look, life insurance is incredibly important for these, having one of the parents pass away has a huge significant impact on the household. Our position is often we want to cover 10 years worth of after-tax, after mortgage repayment income for each individual, with a floor being $60,000 a year. Olivia's income isn't $60,000 a year, but should she pass away, we want to cover a minimum of $60,000 a year. And we do, account for inflation. The next thing is cover the debt. So if one was to pass away, we're clearing that mortgage as well, a little bit of money for a funeral. And then we take away the superannuation balance. So if individuals have really high super balance, then maybe it negates completely the need for life insurance because that super balance will cover those costs. And then if we're retaining cover, again, we don't know for these guys if we would be retaining cover or not. That comes later in our research, but would we net off any existing cover we may already have? When it comes to life insurance, we often have the level of disability cover for young clients, especially for young families. The total permanent disability cover requirement is always, or not always, but often higher than life insurance. So we just match those two together and link those policies together. It often actually becomes much cheaper to do it that way than to separately have life insurance lower than disability cover. But as I did say, I did give a warning. I am geeking out a little bit on these example, this case study. Okay, so next up, we go from the level of cover. Now at Sky, we always do heaps of research on the your medical history, underwriting, who's the most appropriate insurer based off that first and foremost. But in this situation, we didn't get any health information, and so we're going to assume that we're not getting any exclusions or loading. So the reason why that is the case, it means we're free to go anywhere with our insurance provider. If we did have an exclusion or loading, it does limit us in terms of where we want to go, because my philosophy is that is the number one most important thing, making sure the coverage of the policy is as extensive as we can get it to be, because there's nothing worse than going to claim and being told, actually, you've got an exclusion, or that's a pre-existing health condition, we're not going to cover that, we'll decline that claim. So for this case study, we're just going to assume we can go anywhere. And the reason why I talk about that is because cost. Maybe cost, when it comes to our philosophy, always put cost as the second or third most important thing. Health history is the most important thing. But for this client, I'm just going to look at the cheapest premium in the market. And just to give you some rough idea on numbers. Multiple insurers for Sam, we're looking, I'll actually give you a cross section, we're looking around $3,000 in total, up to around $3,500. There's multiple insurers who would offer that cover for that much. Now that's in total. We can split it between super payments, so the SAM Super Fund, even though the policy won't be owned in ART, they can still fund a lot of the premium. One insurer would offer $38 per month from cash flow. Now that pays for things like trauma insurance, pays for things like own occupation TBD, and so there are definitions that I personally believe are really important, and we've had clients claiming on these features, so that's why we build them in for these guys. But it means that this isn't cheap as chips cover. This isn't as cheap as we can get. We can get it cheaper if we want to dial back on certain aspects of the policies. But for Sam, it's about $38 per month from the bank account, from the cash flow, and $2,630 per year from superannuation. What that means, and structuring it this way is, and this is exclusive of the ART cover. ART, all of those considerations around those stage TBD payments won't be included in this cover that we're looking at pricing out. This policy is a lump sum TBD policy, full income protection until age 65 for that income protection policy, which is super important. 30-day waiting periods. Again, this is not cheap as chips policies. And so that's the cover that we'd be looking at for Sam. For men and women, the costs are different. The structure is different. But for Olivia, for those sums insured that we talked about before, we are looking around $1,800 to around $2,200, depending on, there's a spread between like 4 or 5 insurers. So the cheapest, again, may not be our recommendation based on health history, but just to give you some idea, is $1,300. In a live recording, I said $13,000. It's a wild number, but this is $1,340 per year from the super fund, and just shy of $41 per month from the bank account. In total, that's $1,831 per year in premiums for good quality policies. We are looking at own occupation TBD, income protection, trauma cover. So you've got, well-rated policies, great featured policies. And so that's kind of a cost, gives you a cost guide. Okay, so those costs are taking out cover with a retail provider that an advisor will help set up. Now, the question is always, why don't we just go to ART or Aware and just increase the cover through there? So some of the considerations are you can't get trauma cover with your super fund. They won't offer it. It needs to be paid outside of super. Things like disability insurance, so that TBD, it can only be based on what's called an any occupation TBD and not an own occupation TBD. So there are some limitations with regards to that. But there's also a legitimate consideration is, well, even those things being the case, do we still increase it within the super fund? Get it all paid through super. There are some concerns with income protection as well. I won't geek out too much, but we've done a quote comparison for these guys as well, considering the existing cover. Now, if we were actually giving advice to these guys and we did recommend they cancel their existing cover and take out policy somewhere else, we give a full replacement table comparison, which shows, pros and cons, like for like, everything. So for the cheapest provider for Sam, we're taking that comparison. comparison. Now, we're taking off things like own occupation TPD, trauma insurance, some of the features and benefits for income protection that makes it a little bit more expensive but easier to claim on. They're the things that we're scoping out. If we were only take out that cover through the super fund, it would be about $2,440 Sam, without some of those other policies and benefits. And ART, if we went to increase it with ART, they'd be charging Sam $5,121. So this idea that we so often see in our business is people think that, going back to the super fund, it'll be cheaper. I can pay it all through super. It's cheaper, easier, better. ART is over double the premiums. Now, it doesn't mean ART is not a good super fund to be in, but it does mean that maybe the insurance provider that ART has selected isn't the best for you as an individual. So that is definitely something to consider. Is it isn't true that the super fund will always get you the cheapest premium because they price it as a group. And then there's a whole bunch of other considerations when it comes to owning your policy through this super fund. So if we set it up, even if we scoped out all of those, trauma policies and everything and just paid it all through super, having this provider that's half the cost of the ART insurance gives flexibility. So if an individual wants to move their super fund from ART to Host Plus or Australian Super or wherever they want to go, self-managed super fund in the future, whatever they want to do, they can take these policies with them and then new super fund can fund these premiums, which is a massive benefit because you want to set up your policies really well, potentially once, and then maintain it for a long period of time unless you choose to change it in the future. You don't want to be forced to change, we're moving super funds, so we have to redo our insurance policy. You want to be able to just have them both separate from each other, even if they're funded by that policy. Now, for Olivia, it's a little bit different. The premiums for Aware is actually slightly cheaper. So $50 or $60 cheaper than the provider that was the cheapest in that other comparison. Again, we're not having trauma insurance. We're not having the better income protection policies, no own occupation TPD, but it is slightly cheaper through Aware. Now, sometimes it is still a consideration that not linking your super fund with your insurance provider is sometimes beneficial, but it's also the features and benefits of the policy. Now, this is never a reason to move away from a super fund or not, and price has a big draw card when it comes to it, but the feature score, so the actual nitty gritty of the policy, what you're actually going to get paid out on can be much more watered down or not as easy to pay out on when it comes to a policy like an Aware super policy. And to be honest, the policies with Aware can change, just like every super fund. If you don't own the contract, they can change over time. So again, super geeking out on it. And once again, I'm not saying we would recommend Olivia move away from Aware because that cost savings could be really important for Olivia. And then we'd do things like, okay, let's look at a 10-year projection on premiums. So maybe Aware could be the right move for Olivia. Again, depends on their individual circumstances. And so for someone like Sam, where that cost differential is massive and there are a whole bunch of benefits moving away from ART, that could be a real easy no-brainer. But for someone like Olivia, what do these scores actually mean in real life when it comes to the T's and C's of the policies? Some of these, features and benefits is like guaranteed upgrades of the policies, guaranteed renewable, so the policy can't be cancelled on Olivia if we keep paying the premiums. Are those important for $70 a year? The ability to freeze your premiums if and when you choose to under certain options, is that important? Guaranteed increases when it comes to guaranteed future increases. If you have life events, we can increase that life and disability cover. Are those things worth the $70 a year premium increase? They may be, they may not be. So there's some of the considerations when it comes to it. But sometimes if it's a worse rated product, and double the premiums, sometimes that makes our job really easy when it comes to these considerations. And then when you overlay the idea of, do we want to add trauma insurance? Because if I have trauma insurance that's standalone, that may completely wipe out that $70 a year premium savings. So there's a whole bunch of considerations when it comes to these guys. As I said, please don't go off and if you're with ART, go and move your insurance somewhere else because I heard once on this video that it was twice the cost. That is definitely not going to be the case for every individual client. Premiums are so subjective based on occupation, based on age, based on a whole bunch of factors. So don't take away from this that ART covers no good because for Sam, we could very well be recommending Sam maintain that cover where it is based on a whole bunch of health factors. So I hope this has been a helpful deep dive on this case study. I'm sure I'm going to hear from Glenn that this went way longer than what he expected, but I am an insurance nerd. I love talking about insurance and I love having the ability to go deep on this. Don't take anything that you heard today as advice because it's not. I'm just talking about these fictitious individuals with no understanding of their health history. Thanks heaps for watching and thank you, Glenn, for having us on the podcast.